clap here. We've got 10 people, so great job. And for those people who are here, don't forget there's a grab bag of gifts over that you should take with you when you leave. Thanks so much. I want to move on to the private equity panel. So again, we've had a speaker from Hong Kong. Camille represents Dubai Family Office, and now we have some speakers from Europe. Mark Heel's going to be leading the group. Mark, you're a seasoned moderator of our panels, so take it away. Tell us what you do.
Well, sure, and thank you, Marty. Can you hear me?
Yeah, you good.
Yep. Okay, perfect. Just wanted to check. So welcome this morning. Thank you, Marty, for this great opportunity to be in front of all these wonderful people and to speak to them about opportunities in private equity. I've got a really terrific panel, so I'm very excited about this. We have Ricardo Miro Casada, Managing Director and Head Chief Investment Officer of Private Equity and Impact of Arcano Capital. He is coming to us from Madrid today, so that's Marty's reference to Europe. We have Brenda Chi, Director of Paladin Capital. She is, I think today she's in Washington, but she normally resides up in the Boston area. We have Benjamin Brandes, Director of Private Equity at Cross Country Consulting. He's also a private investor on the side, so we'll bring some insights from that as well. My name is Mark Heil. I've recently just joined a Pacific Premier Trust, which formerly was known as Pensco. So those of you from the Boston area may be familiar with Pensco. It's a trust company. It's been in the business for about 30 years. We have $14.2 billion in assets under custody, 45,000 different clients. We specialize in the custody of alternative assets. We work with broker-dealers, RIAs, asset fund managers, sponsors, ESOPs, defined benefit plans, etc. Just so you know the opportunity set, there's about $9.7 trillion in IRAs and $291 billion in self-directed IRAs. And you may remember the discussions about Mitt Romney and how he had an IRA with $100 million in it. Well, that all came from a self-directed IRA. So and those assets can be invested into alternatives through a self-directed IRA, and that's what we help facilitate. But I'm not the star of this show. My panel is, and I would like to get them speaking. But before we do that, just a couple quick housekeeping things. First off, we're scheduled for about 45 minutes, and I'm sure we can do much longer than that. But we have other people on the agenda for the day. Those of you who see me in New York do these panels, you know I like to make this as interactive as possible. And it's challenging through the internet, but it's still quite possible. You saw Marty bring in people. I'll ask Marty to do that as well. You don't need to wait to the end. As questions emerge, feel free to chime right in. You'll see our panelists going back and forth. It's going to be more like a conversation. So do that. You can also use your chat. The chat feature on the program to type in your questions, or you can type in, Marty, I've got something I want to ask. Marty will bring you into the conversation. So don't wait till the end. And with that, I think we're going to get this started. I know one of the comments yesterday was, it looks like I'm landing an airplane with these. And indeed I am. So let's get the conversation going. Ricardo and Brenda, why don't you just kick off a little bit and talk about the background of your firms, types of investment opportunities you look for, the bite-sized deal structure, geography, control, non-control, all those sorts of things. Ricardo, since you're the furthest away, we'll start with you.
Thanks for the intro, and good afternoon or good morning, everyone. My name is Ricardo Miro, and as Mark mentioned, I lead our private equity practice here at Arcano. We are a financial services firm, so we've got investment banking, multifamily office, and also the asset management division. Within asset management, I run the private equity division, which basically is a private equity fund of funds, really, that invests globally through primary, secondary, and direct co-investments, mainly in the US and Europe, although we've also opportunistically invested in other markets. We manage over 4.5 billion euros across different vehicles. And our focus tends to be mainly in sort of growth and buyout funds. Our ticket sizes really depend on the transaction. We tend to focus on kind of the mid-market. That's where we believe is kind of most of the value, and where we can arbitrage also some multiple, and also the opportunity to improve the operations of the companies. Sector-wise, we're really sector agnostic. We're generalists. The truth is, for the last couple of years, probably the two sectors we've been investing the most are technology, especially software, and also healthcare. And then we'll cover obviously kind of consumer industrial. Probably the sectors we usually do not invest are metals and mining, energy in general, so anything related to commodities, banks and insurance companies, and then real estate and infrastructure. So we leave apart sort of a good chunk of the economy, but we focus in those where we feel more comfortable, doing our due diligence. So again, I'm based here in Madrid, but we've also got offices in New York and LA, given we cover sort of Europe and the US mainly. That's in a nutshell. Yeah.
I was just going to ask you very quickly, healthcare is very broad spectrum. So maybe if you could talk more specifically about the areas within healthcare that you like and don't like, that'd be helpful.
Sure. No, that's a good point. I mean, it's a very broad sector, and I would say that again, we tend to focus in more mature companies, mainly actually in services. So we'll go from anything to kind of hospitals, all sorts of clinics, assisted living, intensive care, and so on. Product-wise, we do have exposure to some, but the concentration or the risk that we assume in some of these early products in their lives is something we don't tend to like. That's usually more of a venture capital type of play that it's a different risk return profile. So yeah, it's actually one of the most successful investments we had. I mean, historically it's grown above GDP. There's a lot to be done in terms of consolidation of some of these subsectors, and actually private equity plays quite well in this environment in which you're looking to professionalize some of these teams, consolidate some of these sectors, and so on.
Terrific.
And maybe just to finalize that, in terms of the way we get access to that sector specifically, and actually similar to technology, it's just like in some cases we'll partner with some generalist funds. In the case of especially technology and healthcare, we tend to partner with people that just invest in this sector, or actually in these subsectors, given they're such broad kind of sectors and need a lot of specialization to get the right angle and really create value.
Terrific. Brenda, you want to talk a little bit about Paladin?
Well, I'd love to take the whole 45 minutes, but I'll try to be considerate of everyone else. So Paladin, in shorthand, is a cybersecurity investor. We've been in this space for about 12 years before the space got really white hot. We've done 48 deals in this space, and a question came up yesterday as to why Paladin, which is really a venture and growth stage investor, is on the PE panel. And I think it's really because private equity is becoming a little bit less siloed as it has been in the past. You're seeing the large funds go to earlier and smaller investments. You're seeing some venture funds becoming more like growth firms. So the way that we invest is we tend to invest early, but we will follow the great deals into the growth stage. As a result, we have a very vibrant co-investment program for limited partners in our funds. We have a global approach. Cybersecurity is a global problem. So we invest globally in deals in the US, in Europe, and a few in Australia, which means we also have a global LP base. We've got family offices and institutional investors from around the world, mainly Europe, Asia, as well as the Middle East. So our past two funds, since 2008, we've generated top quartile returns. I'd like to say, it's top quintile, but I'm not sure of that because I haven't seen the numbers. Top quartile returns in the 48 deals since 2008. We are right now raising our third cyber fund, and I would love to tell you more about what we're doing there. We've done 2 deals so far, and there might be a third before the year is out in the new fund.
And Brenda, if you just give me 1 second, one of the reasons why I wanted you to be in the private equity panel is because if you look at the weighted distribution of funds in venture capital, I would say that it's probably about 80 to 90% in the seed and Series A stage, and there's a huge gap in growth. So I wanted you to discuss, that gap in growth and the opportunity.
Yeah, thank you, Marty. And we do, within each fund, you will have a handful that are incredibly successful, and we will follow them into, for example, a Series C round where it's $50 million. And we may or may not lead that round, but that's the check size, that we are giving to the companies. And that's when we bring in a lot of co-investments. And that is, of course, a hot topic right now in private equity.
Typically lead that syndication in the C round?
We do not in the C round. We definitely do in the earlier rounds. And we also take board seats. We have a very active value add program for our portfolio companies, as well as to our LPs. And once we get to the C round, we typically hand it off to, we partner with more of a growth type firm or even a private equity firm that's looking to do, typically a smaller check size than they would normally do.
Mm-hmm. Terrific. Hey, Ben, why don't you talk a little bit about when a Brenda or a Ricardo would call you and talk to you about cross-country consulting?
What they would call me? Well, they could call me Ben. They can call me a lot of different things, and I've been called worse already today. But firstly, I'd like to thank Mark for moderating this panel. Marty, thank you for inviting me. It's already been a phenomenal day. I've really enjoyed the real estate portion already, so it's great to be here. Cross Country is a leading financial consulting firm that supports and enhances the financial function of portfolio companies. So very apropos for today's sessions. And this can be accomplished usually through an Office of the CFO assessment that we perform that provides a roadmap for accounting procedures, financial statement close process, management and ownership dashboards, all automated through technology tools with partners of ours. So these services are needed more than ever. Visibility into the financial functions of portfolio companies for Brenda's portfolio companies, Ricardo's portfolio companies, and people who are registered for this panels. I help lead Cross Country's financial sponsored coverage group and have worked with a number of registrants at this today. And I look forward to connecting with all, especially for folks who need some of these services in this environment.
Hey, Ben, I got to imagine that when, add-ons are brought into a platform company, one of the biggest headaches is getting those accounting systems talking to one another and flowing with one another and getting the, uniform procedures around everything. So is that where your group sort of gets involved, and what do you see as the challenges there?
It's step number one, and we have a process that's called bolt-on in a box, which is really, helping for integrations of add-on portfolio companies specifically. And, we've worked with a lot of private equity funds that they've called it buy and build strategy. They've called it, portfolio add-on strategy, whatever you want to label this. That integration is more important than ever, because if you screw that up, you screw up the platform. So the things that we do is we come in and with not just a diagnostic tool, but with actual support on the finance function on integration, visibility, coordination, and technology that's integrated through all your platforms to give that existing financial function a better ability to do acquisitions in the future.
So do you have a recent example where you got involved in something like this?
I'll go through my top 6. How much time we have left? Okay. We've talked today. I like the panel before because we talked a lot about real estate. So we've worked within healthcare, real estate, technology, etc., where it could be a real estate investor looking for a number of multifamily properties to kind of coordinate some of the financial functions of those properties. It could be a SaaS company that's looking to integrate some platforms to provide better visibility. So without giving a specific example of one company, I will just say that in every of those industries, somebody mentioned cell towers. In all those industries, there's disparate financial systems, different accounting systems, different people and processes that are doing things. We help coordinate those processes and integrate that adds value. So that's more of a global answer, but it's needed in any type of situation.
That's fantastic. Thank you. Wanted to shift because the market today is COVID. We heard that on the first panel. I'm sure we'll hear that on other panels today. But I guess my question is, a lot of investment banking firms are telling me, this fourth quarter looks really great from them. Of course, investment banking firms are among the most optimistic people out there. So my question to Brenda and Ricardo in particular is what's the fourth quarter looking like for you? Are you expecting some closes between now and the end of the year? Ben, obviously at some point I want you to talk about, the conversations you're having with private equity and private equity funds and portfolio acquisitions along those lines. So Brenda or Ricardo, if you want to lead this off.
I guess I'll jump in first this time. Not a surprise that things were incredibly slow in March and April, both in terms of fundraising and deals. But I think we are truly fortunate to be in the space we're in because cyber is enduring, and with what's happening with work from home and companies, being spread around the country and around the globe, the awareness for security is actually greater than ever. So we've actually seen from May and June onwards that things have really picked up both on the fundraising as well as deal making front. Like I mentioned, we've closed 2 deals in our new fund, one of which is an AI security company. As businesses and governments and individuals deploy AI, in their systems, how do you know it's secure, right? So what we do is we secure the infrastructure of the way that we live now on the internet, in the cloud. We exited a company last year that is a cloud security company. So we are very much driven by the technologies here, the technologies of the future. How do we make them secure so that we can continue to live, online and work as we do. We expect to see in Q4 that things will continue to pick up both in terms of fundraising and deals. We are probably going to close one more deal in the new fund. So we are fortunate to be in this space where after a bit of a slowdown, it's really picked back up.
Terrific. Ricardo, do you want to chime in? Tell me a little bit about, from you're muted, so you have to unmute yourself.
Yeah. So on our side,
it's
sort of a similar situation in the sense that the first half of the year was quite slow, and even during I would say sort of July and so on. Then it's definitely picked up quite a bit. But as in any sort of uncertain environment like the one we're living, there's a huge dispersion. And I would say this depends really on the sector, right? I think people that are holding really good assets in technology, again, healthcare, it may be an interesting moment for them if for whatever reason, they like to get some liquidity for them to sell those assets. And again, the market has actually rebounded quite nicely, right? So there's some interesting multiples being paid in some of these sectors, right? On the contrary, or on the opposite, if you've got a chain of restaurants that again has been closed for I don't know how many months, it's probably not the best moment to try to sell your company, right? And you're probably worried on how you're going to restructure your debt, how you're going to pay your rent. So I would say we do expect a lot more activity, but it's going to depend a lot in the sector that you are. In our case specifically, and from an investment point of view, I would say that I would add another layer, which is, as I mentioned, we do primary, secondaries, and co-investments. On the primary side, so when someone's gonna, is asking us for kind of new capital or new commitments, there's a huge dispersion on those that are completely consolidated managers that have gone through a crisis and have performed well, to those that are trying to raise a first or a second time fund and really have still stuff to prove. On the secondary side, again, it was muted for a couple of quarters. Now we're seeing quite a bit of activity, an interest in discounts, but probably not at such large discounts as we saw a couple of months ago. And in terms of co-investments, well, managers, especially those that haven't been able to raise that much capital, are depending on LPs to chime in with some additional equity to compensate that lack of capital that they may have in their funds, that because of diversification reasons, well, they're looking for some capital from LPs.
No, it sounds great. And I was going to ask, because Marty had mentioned a little bit earlier about repricing in the market. Are you seeing a lot of that? And Brenda, I saw you raise your hand there, so feel free to chime in as well. So Ricardo, maybe you want to start first, and then have Brenda. Or Brenda, why don't you lead?
You want to take it?
I actually had a question for Ricardo, which is, given the slowdown earlier this year, are you playing, is Arcano playing a little bit of catch up, like putting more money out because, the year is coming to an end, you're looking at 2021 allocations, how does that work for you?
No, usually our programs are multi-year. So to be quite honest, I mean, we do acknowledge we don't have the crystal ball, so we are never sort of full speed, nor kind of completely, we don't stop completely. So just like I was saying, kind of in terms of, diversification, in terms of sectors and geographies, same applies to years or vintages, right? So I would say that the beginning of the year, we're probably a little bit slow just because we saw quite high valuations, but to be honest, we've continued to see interesting opportunities. And the fact that the stock markets have rebounded haven't made us any less concerned on what could happen in the next few months. So I would say that we are investing cautiously because I think we still haven't probably seen the worst.
Thank you.
Right. Hey Mark,
Brenda,
I have a follow-up question for Brenda
and
Ricardo, if you don't mind.
No, go right on.
As you guys are evaluating investments, have you put, let's say, more input into what a standard COVID discount would be in your evaluations?
Yeah, again, I'll take that one if you want. So again, I think it goes back to a specific sector. There are some companies that are being benefited by COVID. I mean, we have several that actually are performing better, right? So, and there are others that are performing a lot worse. So I would say that it's hard to put a specific number, but we are definitely being a lot more cautious than a couple of years ago, just because I think there's still quite a few unknowns around what's going to happen in the next few months regarding a second wave. How could that impact certain sectors and so on.
Yeah.
Well, for us, I think it comes down to really smart sourcing of deals, and we try to source them early. We are very thesis driven, so we're going after companies that may not be on the radar screen of a lot of VC firms at this point. But the flip side of COVID is, interestingly, in our portfolio, we had 8 up rounds in our portfolio during the COVID period, which was a very nice surprise for the firm as well as our LPs.
That's not surprising given the sectors you play, but I'd maybe ask you just to chime in a little bit and speak about the drivers for those and why that's happening.
We were seeing revenues being accelerated. So, a lot of the companies that we've invested in or in the portfolio would already meet their revenue targets by September or October. I think it's very much driven by COVID, very much driven by the awareness of the need for cybersecurity. We're also seeing a lot of new customers, coming in. So, the spend of current customers going up, new customers coming in. So even though our companies may be small, we service very, very big corporations. You think FedEx, you think JP Morgan, you think Nokia. They are all customers for the companies that we have invested in. NHL, MLB, they are all customers. I haven't got my NHL tickets yet, so I have to talk to the company about that.
Well, we saw yesterday a very big transaction happen in Major League Baseball. The Mets were sold for $2.5 billion, and that did not include the TV network. So there's always some interesting things to be discussed. But Ben, You were trying to ask something before, and I sort of stepped on you. So why don't you come in and ask what you were going to ask?
No, I think that's the question. I'll just tell you from my perspective is that if I talk to my investment banking friends, I'm going to see a lot of COVID premiums that they're putting on some valuations, which is surprising. And if I talk to my private equity friends, I'm going to see some analysis around COVID discounts. And, you know, as Ricardo and Brendan mentioned, it's very industry specific, obviously. But, you know, now that we've been in this pandemic for 6 months, there's better analysis out there to determine, you know, some level of uncertainty and liquidity analysis and other types of cash management analysis going forward, given what's happened in the 6 months. So I've actually seen it both ways. And there's some pretty interesting data out there on forecasting now in this environment that may be used for other situations going forward.
Very interesting stuff. You know, one of the conversations I'm having a lot with investment bankers is they're saying platform deals right now are very rare. Hard to find a good platform deal, but the add-ons are happening more frequently. And they think that's really what's going to drive the Q4, although they do anticipate it, the market loosening up towards the end of this year for platforms. So I don't know, Ricardo, if that's something you're seeing, hearing, discussing with potential people you're investing with.
Yeah.
And I'll throw it out to you to sort of comment on.
Sure. I think on our side, I mean, look, a part of our strategy, I mean, given we're focused in the mid-market, you know, does involve quite a bit of add-on in general. So I would say that's not uncommon. I would say that there's still quite a bit of dispersion in terms of, you know, getting, you know, the bid and offer, you know, to agree. And obviously, you know, if you have the possibility to wait, you'll probably do so, right? I mean, there are some people, especially kind of in smaller companies that for whatever reason, you know, have suffered quite a bit. And you know, do need to sell. Well, in those cases, you can take advantage of that. But again, activity, I think it's still relatively slow at both levels. Although probably we've seen sort of quite a bit of, you know, a bit more of activity on add-ons. But I wouldn't say there's a huge more activity there than in platforms. I don't know what Brenda and Benjamin have seen in their respective activities.
Hey, Mark, I just want to jump in with one question here, which is that, so one of the issues that popped up in 2008 in the private equity world was that, you know, gates were drawn with hedge funds and in the private equity firms. There was a elongation of liquidity. So a lot of funds that had 10-year liquidity extended to 12 or 13 years. Does anybody here see that happening? Or do you think that most private equity firms, you know, are fairly safe from the shock of all this?
I'm happy to take that one because given we do invest a lot in secondaries, obviously we've seen sort of, you know, it's almost two different worlds, sort of the one we saw over 10 years ago and the one we're seeing today, in the sense that, you know, kind of GP-led transactions, that means when a GP takes part of the transaction in a secondary, almost didn't exist, you know, 15 years ago. Now it represents more than 30% of the secondary volume. GPs have learned that it's an interesting tool to use at their advantage and the advantage of their LPs. So to find solutions. So, you know, in the past, GPs or the managers only did this type of transactions, sort of restructuring or GP-led transactions, if they were deep into trouble. Now I would say they're using it, you know, as a very common tool. And we actually do use it quite often to invest our capital. And I think that just goes also in line with the general trend of, look, people did tend to kind of in the past, you know, invest in a company after 5 years, sell it, and that's it, right? Let the next one take a lot of the upside. Well, that has completely changed. I mean, if you see the number of companies that are listed in the US, for example, has gone down by, I think, half, from 8,000 to less than 4,000 in 20 years. And people are actually holding assets for much longer, right? So what we're seeing actually in the current environment is people, as I was saying, that don't think it's the best moment to sell those assets, either because, you know, they've suffered, either because they want to continue doing add-ons and so on, and they're just holding the assets for much longer. So instead of doing it for 5, they may end up doing it for 10 years, and you know, given they've sourced the asset, given they've been managing it for 5 or 6 years, why let either the market or another private equity fund sort of reap the benefits, right? So that's our view, and I'll stop there. I don't know, Brenda, you're probably seeing something similar, because in the technology world, that's probably where it's more exaggerated.
I just want to jump in, because we did this in 2008. Before 2008, there was probably half a dozen large secondary funds. Now there are tens of them. I mean, there's 20, 30 that are fairly significant. And in the venture capital space, there are very few secondary funds, and family offices kind of jumped into the gap, but now you see more of them. But Brenda, if you have comments.
Specifically for Paladin, we were not seeing the elongation of the portfolio. We're trying to be very responsible and exiting our companies prior to the life of the fund. But what we are seeing is the number of IPOs may have gone down, as Ricardo pointed out, but we're doing a lot of trade sales. We sold a company last year, 2 years ago, to BlackRock. So, PE firms that are looking to get into cybersecurity, they want, technology risk taken out. They may have a platform play of their own. They're doing some sort of roll up. We're seeing that as well. So specifically to Paladin, was not seeing the elongation, but the other hat that I wear is I'm the board chair of a 4,000 person trade organization. And over there with a lot of PE firms, we are seeing the elongation of that cycle. But believe it or not, I think it tends to be somewhat sector specific.
Well, I guess my follow-up question is that, do you really need to go public these days? Because it seems like historically you went public to get access to debt markets and to be able to do roll-ups, acquire other companies. But I mean, there's so much debt available today, even if you're a private company, right?
Yeah.
I mean, it's much more easy to get debt or credit.
Truly.
So that's one aspect of it. And I'll give you an example. We had a CLO firm speak a couple of months ago. They're probably one of the largest CLO firms in the world. And I think the CLO market was about 100 billion at the last crash, and now it's like more than $1 trillion. So, the capital, the credit is there. So,
a major driver for the public market, of course, is deals get to a size where it's hard for another company to buy it and they want to exit. So the public markets still drive that a little bit. But I also wanted to comment, Marty, that you're seeing a lot of innovative products today that weren't available in 2008 initially at the fund level. So they can sell off, strips of their fund and bring in a new investor into it, or simply let somebody else inject some capital into their portfolio companies.
Yep. There you go.
And you're seeing a lot of that. I see debt funds, I see preferred equity products, and these things were not there in 2008, but they are part of the fabric today of the private equity market.
Yeah. Mark, I would add that the whole issue around size, and that, when it came the time to exit, and because of size, another private equity fund couldn't do it. I mean, some of the largest private equity funds raised in the last few months have been secondary players. I mean, we're talking about $20 billion funds. So actually we just closed a transaction. We're part of a syndicate last week where we invested in the largest software company in Europe. It's a 12 billion EV company, and that stayed in private hands. I mean, it doesn't need to go public anymore. I mean, there's enough capital to cover and to kind of keep it private and basically don't let.
I think it certainly stay that way for a long time.
And Mark, you might know the data, but I think that somebody said there's like 3,000 public companies in the U.S., but there's something like 15,000 indices and different mutual funds covering them. So
there's also
about 3 minutes to go.
There's also still 2,000 private equity firms in the U.S.
How many?
2,000 private equity firms.
Well, I thought it was more.
Yeah, maybe even more. So, and maybe that's for like dedicated funds. So the point is that, Marty, you're right. There's so much capital out there, debt and equity, that has not necessarily been hindered by this pandemic.
Yeah, so let's clarify. Maybe there are 2,000 private equity firms, but there's probably several hundred family offices who act like private equity firms.
Right.
a lot of institutional investors, like in the pension space and endowment space, who do direct investment. So I think that the number has moved from pre-2008 of direct investment of about 5% in the family office space to an excess of 30% family offices doing direct investment. So there are lots of people playing in private equity, even if they're not private equity firms per se. So.
Right. So just think about that for a second. Think about all that dry powder, and what has this environment done? It slowed up that investment. Okay, so it's still out there, but now maybe there's less pressure on family offices, but the pressure to put out that money is even more so. So if you're not going to support your existing portfolio companies, you've got to put that money out elsewhere. Otherwise, you lose those management fees. So you're going to be looking for more innovative companies, more companies with hair, more distressed type situations, more early stage. So, I think that from the folks that I'm talking about, investment activity, even though this level of uncertainty is going to increase to levels that have not been seen before.
Absolutely. We got about, as Marty said, just a couple of minutes here. So I want to do two things before we close out. One is Carlos asked the question, and Ricardo, and it was directed towards you. And he was specifically asking about education opportunities in Latin America. I don't know if you play in that market or not, but since you put it out there, I'm going to throw it your way.
Yeah. So good question, because actually education is a sort of a subsector where we've been spending a lot more time. We are to the point where we're actually launching an impact fund that will invest, and one of the four main key themes is actually education. So we are definitely going to be investing, have been investing, and will continue to invest into education. Truth is, most of the stuff we do is in the US and Europe, just because from a risk-reward point of view, this is where historically we found the best opportunities. But I'm actually Peruvian. We've invested in Latin America and actually do know some interesting companies over there. And yeah, we'd be happy to kind of, have that conversation. Again, we usually partner with local private equity funds. So we usually don't go, if we go direct, it's with some local partner. But happy to have the dialogue, because obviously we know a lot of people that invest into the education sector, and with whom we'd be happy to partner.
And we got another question here from Connor. So I'm going to ask this quickly, and it's open to people. Leading up to the pandemic, we were seeing a shifting GP-LP relationship as a growing number of LPs looked for more active roles in managing their money. My question is, have any of the panelists seen this momentum hindered, altered by COVID-related impacts, whether that be virtual deal management, etc.? So there you go. Great question. Basically, wanting to know, have you seen the momentum of people looking to become investors, wanting to be more active in the deal, or in the management company of the private equity firm or venture capital firm?
We have a very engaged LP base, and we don't, they don't get involved in the portfolio companies per se, but we're definitely answering more questions about what's going on, especially around the pandemic and how valuations are, et cetera. And I think, with Zoom now, it's just much easier to do that, right? We don't have to fly around to visit people and all that. And this may actually be a trend that is here to stay. More engaged LPs via Zoom, not a bad thing.
Well, they also have to be a little careful, right? You don't want to pierce and become liable for pension liabilities, things like that. So you have to be a little careful around the issue. Ben, you're going to say something?
I was going to say that, look, I've seen LPs, and as Marty mentioned, family offices wanting to do more direct investing because the private equity asset class has done well. And it's fun. I have not seen the COVID impact decline in terms of that interest level. What I have seen, as Brenda mentioned, is different tools on how to go look for deals, scout out deals, do due diligence. And I don't think those are going away, whether it's Zoom, whether it's technology, whether it's other areas for people to communicate. to get deals done. So I think that's a net benefit to this environment. And when we're all able to see people in person, and one day we'll go to Boston and visit the offices, Marty, that you're in, that'll only increase.
That's great. I'll let the law firm know. So I have a quick question. So Ricardo, you're in Europe. Do you think that I'm not sure about the variation of European private equity firms versus American ones, but do you think that there's a lot of unfound? I mean, you have feet on the ground in Europe. Do you think that there's great opportunities in Europe compared to the U.S.? I mean, there's just so many private equity firms here in the States versus Europe. Can you talk about that environment?
Sure. Look, I think there are almost as many private equity firms in Europe than in the US. It's just a matter that there's a lot more sort of local, right? Because there's language barriers, cultural barriers, legal barriers. So yeah, I think there's a lot of opportunities. It's changing, and obviously it's becoming a lot more dynamic, but I would say that there's still sort of an advantage basically for people that are based in some of these local economies. Technology is also a good example of, historically everyone's looked into the US, obviously, but that's changing quite rapidly. And I think there's some interesting assets over here in Europe, for example. Actually, if you look at the number of companies, it's the same in terms of small and mid-cap companies. The great difference between the US and Europe in terms of technology is that we don't have these, mega billion type of assets. That's changing, and I think structurally we'll continue to see that. But yeah, we still believe, obviously, that especially in certain sectors and so on, Europe is a very interesting play.
We have a lot of immigrant members in New York from Poland, and I think there's a great story about Poland and industrial might, et cetera. I think there's a lot of outsourcing of German manufacturing to Poland. Do you guys look at Eastern Europe at all, or?
We've done stuff in Central Eastern Europe. Actually, Poland is probably the most developed of those. I mean, it's next to Germany and so on. The risk reward of going further east we're not always happy with it, but there are very interesting opportunities of consolidating some of the sectors in the different countries and so on. So yeah, definitely we do have exposure to some of these economies, but always through local teams, right? I mean, again, it's from
Perfect.
one country to the other, it can change a lot.
Well, listen, guys, I think you've done a great job. I have to move on to the next speaker. So I'm going to give you guys a hand again.